Mobility is no longer a business of moving people. It's a business of escaping the gravity of physical assets. In 2026, the industry is undergoing a great decoupling. While some are drowning in a $12 billion sea of depreciating metal, others have built software fortresses that print cash regardless of who owns the car. This isn't just a market shift. It's an evolutionary split. Think of it this way. The old guard is still trying to master the art of owning the horse, while the new winners are simply charging rent for the road. If you're still valuing these companies based on fleet size, you're reading a map from 1995. Welcome to the era where code eats cars for breakfast. Remember the EV hype of 2022? Well, the bill just arrived, and it's a $12 billion headache. Hertz and Avis didn't just buy a fleet. They bought a ticking time bomb of residual value collapse. Used EV prices fell 25% YoY in 2025, turning balance sheets into horror stories. Buying an EV fleet in 2024 was like buying a high-end smartphone, only to realize it has the battery life of a 1990s Game Boy. Once the resale value evaporated, the business model followed. When your assets lose value faster than a meme coin in a bear market, your green strategy becomes a red ink catastrophe. This is the structural impairment that separates the strategists from the enthusiasts. Why is Uber printing $10 billion in free cash flow while rental giants are printing excuses? Because Uber figured out that managing code is fundamentally superior to managing metal. $10 billion is enough to buy a brand new Tesla for every single person living in Manhattan, twice. This asset-light supremacy proves that operational leverage now comes from algorithmic density, not procurement scale. The asset-right pivot means the smartest players are shifting their weight from the backseat to the cloud. In 2026, owning the car is a liability. Owning the infrastructure that tells the car where to go is the ultimate moat. One is an anchor. The other is a jet engine. Meet the three I's of the mobility apocalypse: interest, insurance, and identity. High interest rates have turned fleet financing into a luxury hobby, while insurance premiums are rising faster than your blood pressure after seeing a repair bill for a smart bumper. Then there's the identity crisis of gig work. Regulators in the EU and US are demanding that partners be treated like employees. These three factors are the common divisors that have flattened the margins of anyone who hasn't automated their way out of the chaos. If you can't hedge these three horsemen, your business is essentially a non-profit organization that just hasn't realized it yet. Regulation isn't just a hurdle, it's the invisible ceiling of this industry. In the US, the OBBBA repeal has killed the EV party, while the EU's AI Act is now auditing pricing algorithms like their tax returns. In China, data security isn't a suggestion, it's the license to exist. These aren't just legal notes, they are policy ceilings that cap your upside. Navigating this is like playing a game of Tetris, where the blocks are made of legislative paperwork. If you don't have a compliance-first architecture, you're just one update away from a permanent shutdown. In 2026, your chief legal officer is more important than your chief growth officer. Let's talk about financial Photoshop. In 2025, many profits were just accounting illusions. We're seeing companies delay fleet impairments by using, quote, subjective estimates. Basically, they're pretending their cars are worth more than they actually are. Then there's revenue smoothing, where driver incentives are shuffled around to make gross bookings look like a hockey stick. And don't get me started on the $5 billion in valuation allowances that mask real GAAP losses. If your net income is built on tax benefits rather than trip fees, you're not a mobility company. You're a hedge fund with a car-hailing app. Don't fall for the headline. Look for the cash. A company's fleet age is like its wrinkles. It tells you exactly how much stress they're under. Hertz is desperately selling off assets to keep their average age around 18 months, while Lotte Rental in Korea is extending car life to 7 years to hide the depreciation hit. Extending a car's life to 7 years is the corporate equivalent of putting a fresh coat of paint on a 20-year-old house and calling it vintage. It works for a while, but the maintenance costs will eventually come for your soul. We're seeing a massive divergence. Some are rotating fleets to stay fresh, while others are holding on for dear life to avoid the write-down. Managing residual risk is now the only game that matters. Hertz is trying to become a car dealer to salvage value, while Lotte is using internal auctions to keep the margins in-house. Lotte's 7-year life extension saved them 6.8 billion Korean won instantly. That's a lot of money to find under the couch cushions. This shift to program buying, where OEMs agree to buy the cars back, is the only thing keeping the rental industry from a total blackout. If you're exposed to the open used car market in 2026 without a safety net, You're basically skydiving without a parachute. Good luck with the landing. There is a massive green gap in the industry. Didi is crushing it with 74% EV mileage, while Sixt and Hertz are stuck in the mid-teens. Uber and Lyft have these beautiful 2030 targets, but at the current pace, they'll need a miracle or a lot of carbon credits to get there. It's easy to put a leaf in your logo. It's much harder to convince a driver to buy a car that loses half its value in 24 months. The reality is that the green revolution is currently a green subsidy game, and those who can't secure cheap electricity and batteries are falling behind the curve. Compliance isn't a cost center, it's an insurance policy. Didi's 8 billion RMB fine is enough to buy every person in China 2 cups of coffee. Uber's $148 million settlement is a drop in the bucket by comparison, but the cumulative weight of these fines is staggering. These aren't just business expenses. They are direct transfers of wealth from shareholders to governments because management thought they could skip the paperwork. In 2026, moving fast and breaking things only works if you aren't breaking national security laws. If you don't pay for the compliance today, you'll pay for the lawyers tomorrow. AI in mobility isn't a chatbot that writes bad poetry. It's the nervous system of the operation. Xiangdao is using AI to onboard drivers 95% faster. That's the difference between a driver earning money today or waiting 2 weeks for a background check. Sixt uses yield optimization algorithms to squeeze every euro out of their fleet. Meanwhile, the laggards still view AI as a risk to be managed, rather than a tool to be wielded. If your AI strategy is just, we're looking into it, you're already obsolete. You don't need vision, you need execution that shows up in the margin line. The ghost in the machine is finally getting its driver's license. We're moving from PowerPoint presentations to mass production. Didi's robo-taxi venture with GAC and Waymo's expansion into Dallas aren't experiments anymore. They are commercial deployments. By Q2 2026, the Uber-Lucid partnership will have 20,000 EVs on the road. The labor cost of a driver is the single biggest tax on mobility. Removing it is the holy grail. We're standing at the edge of the era where your driver is a line of code that doesn't need sleep, health insurance, or a tip. The race is on, and the finish line is a 0% labor cost. Let's look at the scoreboard. Uber is the heavyweight champion with $52 billion in revenue and a 16.7% EBITDA margin. They're playing a different game than everyone else. Lyft is the scrappy challenger, finally showing $1 billion in free cash flow. But look at Hertz. Revenue is down, and margins are negative 3.9%. That's not a business. That's a very expensive car collection. The market is rewarding scale and software, while punishing debt and depreciation. If your revenue growth doesn't come with margin expansion in 2026, the market will treat you like a utility company, and not a good one. This is the ultimate BS detector metric. Lyft and Uber generate over $1.5 million per employee. That's enough to buy every single worker a Ferrari, every single year. Contrast that with Hertz at $330,000. Why the gap? Because software scales. People and parking lots don't. This 5x efficiency advantage is why asset-light models will always win the capital allocation war. When you can generate 5 times the revenue with the same human capital, you aren't just faster. You're a different species of business. Efficiency isn't just about cutting costs. It's about having the right architecture. Geography is destiny. Uber's $26 billion dominance in North America is their ATM, but the real battle is in APAC and EMEA, where local heroes like Grab and Didi are digging in. Revenue density is what creates the flywheel. The more rides you have in a single square mile, the lower your wait times and the higher your margins. A global footprint is nice for an ego, but density is what pays the dividends. In 2026, it's better to be the king of one city than a ghost in 50. Focus is the new growth. The super app isn't a myth. It's a gravity well for consumers. Uber has figured out that once you're on the app for a ride, you'll stay for the tacos. 58% of new delivery users are new to the platform. That's a massive customer acquisition engine. Multi-product users are 3x more valuable than single-service users. This network liquidity is why the asset-light model is so hard to kill. You aren't just competing with a car. You're competing with an ecosystem that knows what you want to eat, where you want to go, and how you want to pay. Don't count the rental giants out just yet. They have the moats of convenience. Prime airport concessions are the beachfront property of mobility. Sixt has mastered the premium moat, with high-tier fleets that command higher margins. 33% of Hertz's transactions don't even involve a counter. That's frictionless, metal. These companies own the physical touchpoints that software can't replace. If they can solve the EV hangover, their infrastructure remains a massive barrier to entry for anyone trying to build a fleet from scratch. Owning the dirt still counts for something. So who wins the 2026 mobility games? The leaders are those who balance asset-light scale with AI-driven depth. Uber and Didi are the obvious titans. The vulnerable are those anchored to metal without a brain. Hertz and Lyft are in the danger zone if they don't pivot faster. We're moving toward a world of autonomous infrastructure, where the line between a rental car and a ride-hail disappears. In the end, the winner won't be the one with the most cars. It will be the one with the best data. The asset graveyard is full of companies that thought they were in the transportation business. We're in the efficiency business. That's the 2026 outlook. If you want the full-page data pack with every single spreadsheet and actuarial adjustment, you know where to find us. Drop a comment below with your take on the EV reset. Is it a temporary glitch or a terminal illness? Don't forget to follow at HDIN 230 for more deep dives. For strategic consulting or tailored market research, hit us up at sales@hdinresearch.com. The future is moving fast. Don't get left at the curb. I'm the Chief Analyst at HDIN Research, and we'll see you in the next deep dive.